All right, well, welcome everyone, and thank you so much for joining us today. We certainly appreciate you taking the time out of your day to be with us. So today we are here for a conversation about the wonderful world of startup capital raising. Specifically, we will be joined by experts who will share their insights and tips about how to understand what investors need to see before funding, how to speed up your fundraising cycle, and how to increase the likelihood of a successful capital raise. So before we get going, I'd like to bring up a few housekeeping items. We're certainly planning for a Q&A session here at the end, so I encourage you to write down any and all questions that come up. You can see here on the question panel on the right side of your screen. So if anything comes to mind you'd like to expand on or that you didn't see covered, certainly write us a question and we will address it here at the end. Also, a quick note to let you know that the slides and a recording of the presentation will be provided in a follow-up email after the webinar. So without further preamble, let us jump into the webinar. So if you've ever raised money for a startup, you know what a time-intensive process it is. Even for successful, seasoned entrepreneurs, it can take 6 to 9 months with dozens, if not hundreds of meetings to secure a term sheet from an investor, and that's if you do that at all. Beyond the time and energy expended by the fundraising team, typically led by the CEO, there is an enormous opportunity cost in the form of missed sales or partnerships. Decreasing this fundraising time can make a huge impact on a business and its chances of success. Today, our aim is to equip you with the information you need to know to increase the odds of success in your next capital raise. We will do so with the help of individuals who have experience on both sides of the table, one as an investor and the other as an entrepreneur. Specifically, we will be chatting with the founder of Visible.VC, who was able to secure growth capital from Lighter Capital in a remarkably short amount of time, which you may have guessed from the title of this webinar was a mere 15 days. At the end of this webinar, we hope you will have a better sense of what legal documents, financial data, and operational metrics investors need to see. We will also cover the best ways to engage with your stakeholders in a timely manner and explain why this is so important to your odds of success. So let us meet the presenters. Today, we will be joined with our Chief Investment Officer from Lighter Capital, Alan Johnson. In his role as Chief Investment Officer, he oversees all investments across the United States. And before joining Lighter Capital, he spent 13 years at GE Capital, leading numerous teams in the credit management and sales organizations. And our second panelist is Mike Pruess, CEO and co-founder of Visible.VC, a stakeholder engagement platform used by over 500 companies across the globe. Prior to Visible, Mike was the head of business development at FormSpring and oversaw partnerships as the network grew to 50 million users. He's based in Chicago, a graduate of Indiana University, and an alumni of the Orr Fellowship Program. So, Alan, could you please talk to us a little bit about Lighter Capital?
Absolutely. Thank you, Tom. Excited to be here today and share a little bit more about fundraising. So, the Lighter Capital was founded in 2010, based in Seattle, Washington. We believe that we have created a new fundraising path for early stage tech companies, and it's definitely working. Thus far, we have deployed over $100 million across 400 rounds of financing. Some of the highlights, the vehicle which we've created the fundraising path is revenue-based financing. Some of the highlights and benefits of our product is that we can provide up to $2 million in growth capital, all of which comes with no equity dilution, no board representation, no financial covenants, and no personal guarantees. Not to mention, as you've, again, by way of the title, that we can fund very quickly as opposed to other capital sources.
All right. And Mike, could you give us a similar overview about Visible?
Yeah, thanks Tom and Alan for having me and all the attendees for joining. Just a little bit quickly about Visible. We started in 2014. We are a stakeholder engagement and data distribution platform. So what that means is we're helping companies put together really beautiful looking reports and data stories for their different investors, stakeholders, lenders, and doing that automatically. We are helping we're helping companies do this all across the globe. So we have 500 companies all across the world and growing quickly. And we're doing this by connecting to data sources that you're already using and really automating that entire process.
Excellent. Thanks, Mike. And so now as we begin, we'd like to chat about, obviously we don't know what investors need to see, but I think it's important to take a look at kind of benchmarking what it means to kind of the overlay of security equity financing. So Mike, maybe you could, as a CEO who has raised equity financing, as well as someone whose customers are obviously courting investors, maybe you could share some of your insights there.
Yeah, I think, one of the biggest things to think around equity financing is that it's very much a process in the sense that it's not something that can be done on the side or haphazardly. It needs to be done by the CEO or in the founding team. It can't be given to somebody else in the company and have them in charge of it. And it's a really, really long process. I think a lot of people definitely under index on the amount of time it takes to really get people to invest in your company. You have to build relationships. You have to build a pipeline of investors to talk to. You got to build momentum. You have to be a competitive process, have inbound interest, and all of that really does take time. I think if you talk to people like, oh yeah, I can get this done in a couple of months, but the realistic benchmark here is that it's going to take at least 6 to 9 months to close any type of deal. The success rate is also really, really low, right? You're looking at 1% of companies that are successfully raising VC funding. And the one thing is you're going to get a lot of no's throughout that. You might have great looking metrics and a really solid business, but you're going to get no's for a lot of different reasons. Maybe there's a lack of scale, meaning someone's going to throw that question like, how does this become a $100 million business? Which is ridiculous. You might be a huge business, but if you don't have that quote unquote unicorn trajectory, you're going to get a lot of no's from a lot of investors. The addressable market, right? That's another really easy kind of hole to put into a business is, well, how big is this market? Kind of leaning back on that scale thing. So it's really time consuming, and it's a process, and it's a big distraction depending on how you're doing it with the business. That's going to affect things like hiring, sales, productivity, your product team. So it's got a lot of pros and it's got a lot of cons. But it's a very time-intensive process.
Hey, Mike, this is Alan. You guys you founded in 2014, and I believe you raised your seed round in
2014, yeah.
2014. So is it right as were you pre-revenue when you raised, or were you?
We had some revenue when we raised that, not a ton. I think we were doing a couple thousand a month in MRR. We were more painting a story around the opportunity, the team, the product, and at that point, less around hardcore financials and metrics at that stage.
Gotcha. And how was the experience? I mean, as you're in the process of building the business at that time, right?
Yep.
For capital. I mean, were you the primary fundraiser for the business?
Yeah, I was. And we were fortunate in the sense that we were born out of a venture fund, and our round was led by another venture fund who was also trying to solve this problem internally. So we actually had inbound interest. And even with the inbound interest, I would say from kind of the first conversation to the last, February to July was just the term sheet, and then the close was a couple months later after that. So even with someone that was hot to trot, it was still a long kind of 6-month process. And we also did a follow-on not too long, about a year later. And that was a very much of a long process as well in terms of getting existing investors on board and getting new ones into the business. But even kind of just with someone that was really eager to get the deal done, it was a longer process.
Tough, yeah.
Yeah, excellent. So we have you provided some data here. Maybe you could just talk us through this.
Yeah, so there's a gentleman, his name's Chris Jans at Point9 Capital. They're a VC fund investing primarily in, if not exclusively, in SaaS companies. And he has a ton of great content. I would definitely recommend following him around all things SaaS metrics related. And every year he kind of puts out this back of the napkin math in terms of SaaS metrics and what it takes to raise. And his recent one that he just published a month or two ago, what's it take to raise capital in 2018 for SaaS companies, you can kind of see here. So the top box is kind of what are the annual recurring revenue metrics for Series A and Series B companies. So you can see that the median is $1 million in ARR for Series A, and respectively Series B is $5 million. So you have to have some pretty serious traction to get to both of those benchmarks in terms of just pure ARR dollars. And then if you look below that, it breaks it down in terms of growth at the time of the investment. So most investors, you can see here, there's a count of the sample size they put together, are not going to even be excited unless it's growing at least 3x year over year, so 300%. You can see the breakdowns of percent by that, but the kind of the key takeaways he had in this report were that the hurdle in bar has never been higher, right? There's more SaaS companies than ever. There's more competition than ever. And so that's kind of raised the bar for seed, Series A, Series B investments. They're not going to get excited unless you're growing, insanely fast. And because of this, raising future rounds will be challenging. You might be successful in raising a seed round, like I mentioned, with a product, a team, and a story. But if you take that seed money, you're not $2 million in ARR and growing 3x, you're going to have a really, really hard time raising that Series A. So this is kind of just an interesting study they put out around the VC funding in the highest bar it's ever been.
Yeah, excellent. Well, thanks so much. That's some very, very valuable insights from the equity side. So Alan, maybe you could provide similar insights about securing debt financing.
Yeah, absolutely. So it's probably worthwhile to kind of start out by making the delineation between, obviously there's a lot of different debt products that are out there. There's alternative, there's venture debt, there's your traditional commercial, SBA, working capital. You can kind of go through the list. So obviously without diving into each of those respective types or providers, we kind of state a little bit high level here in terms of kind of what is required and why you might, the challenges associated with it. So while the timing tends to be a little bit less than the equity raise side of things, it can still take, 3 to 6 months. And it's just really, it depends upon the complexity, the stage of the business. Are you, in the case of if you are venture backed, then you're a tech company, then quite often the respective VC will have relationships with some of the tech banks, whether it's SVB, Square One, or so forth. And so in that case, if you meet their respective metrics, it's easier to get financing. If and that generally follows the venture debt side of things, which we'll chat about a little bit later. If you're looking for working capital and you're going to your local bank, that quite often can be a lot easier, but you're typically going to be a signatory loan and easy enough there. If you're going down the SBA route, it gets a lot more difficult, or your traditional commercial lending, because often there are no assets, right? So it's very difficult for banks who are relatively conservative to get comfortable with providing capital to a company that has no assets and a lot of times burning. And so they've yet to get comfortable with that, unless, as I mentioned before, unless the preferred VC is in the picture. Reason that, so in the success rate it's hard to say. I mean, this is, a matter of like what type of product it is, who you're talking to. Now, the fact that we have local, regional, and community banks, it's as well as the nationals. There's often times you can find it, but not necessarily any specifics around the success rate. The reason that, typically that there's a no is that it's just a matter of at the end of the day, it's about they're assessing the risk to get repaid. Right, unlike an equity investment where they're assessing the exit in the future for a 7 to 10x return, lenders or debt providers are assessing the risk of their getting repaid in the period of time in which the loan is outstanding. So a lot of times it's a matter of if the pathway to getting repaid is unclear or deemed too risky, it's common for a no to come, right? And a lot of times the reason that it might be unclear or deemed risky is because the financial statements provided are poor or incomplete, or if they're requesting documents to support the business, those documents are not available, and therefore it creates doubt in the mind of the debt provider of kind of the I don't say the validity, but the basis of getting repaid on their investment.
Yeah. Okay, now, so we've talked about looking at maybe the high-level overview of these two sides of a similar coin. So, Mike, maybe you could chat about what investors need to see, kind of, again, from the equity perspective.
Yeah, absolutely. So I kind of broke this down into a kind of need, like, and love. But on the need side, you're going to have legal docs, right? Your corporation documents, your certificate of incorporation, your articles of the business. You'll have to have your cap table, right? So who owns what of the company. So these are all things that that they need to see prior to close, and that if you don't have them, you'll be creating them prior to that. The things that they like to see, again, kind of touched on this earlier, but the team with a high pedigree. So a lot of people are investing in the team. They want to see some, especially with SaaS, they want to see your KPIs with what kind of tractions. And I think really the biggest one here are the investing in lines and not dots, right? They want to get to know you, how you think, how you react, and your trend over time. They're not going to come and make an investment on a single point in time. They want to see how you grow, how you change, and how that relationship matures. So that's the biggest thing is really kind of establishing relationships with a lot of these venture investors. And then things that are really great that they obviously would love to see are kind of customer acquisition model. That's really in vogue these days. Is how are you acquiring customers? How much is it to acquire those customers? And are we underwater with that kind of model, or are we to be making money with that customer acquisition model? Hiring plans, so use of funds. How are we going to use this capital? Who are we going to hire? Who are we going to bring onto that team? And like I said earlier, kind of insane growth as you go from seed to A to B. The trajectory of tripling each year. They want insane, 300% growth year to year, and then double. So they want to see that hockey stick in terms of the traction that you have.
Yeah, excellent. Thank you. And Alan, maybe you can provide us some insight about what debt providers are looking to see.
Yeah, absolutely. Compared to, I made this reference earlier, but compared to equity, right, the debt side of it is really kind of assessing. It's less about that extreme upside, and it's more about the repayment. And so that repayment comes by way of kind of the foundation of the fundamentals of the business. It's quite often, you will not see debt providers that are investing pre-revenue. So the reason for that is they can't assess the risk, and that's where the equity investors come in. So that being said, you're obviously looking for historical financial statements, right? So depending upon the lender or the debt provider, that'll vary. Some are going to want to see 2 to 3 years of traction. For Lighter Capital, we like to see a minimum of 6 months of operations before we can kind of start the discussion. So a little bit on the earlier side of things. Obviously, want to understand the revenue model. Again, this kind of all comes back to the ability to get repaid. So understanding the breakdown of the products and the churn and any customer concentration and the risk of that. Is there outstanding debt, right? Is it necessarily convertible debt is viewed differently by different institutions. For Lighter Capital per se, we just want to see that it extends out a bit, but it's not necessarily something that has to be cleared out of there. But if there are lines of credit outstanding or other term debt, MCA facilities, it can start to make things a little bit sticky in terms of assessing that risk. Therefore, lenders want to understand what is actually outstanding and on the balance sheet. Corporate documents, as mentioned by Mike, are obviously important from the formation of the bylaws, the breakdown, the cap table, so forth. What lenders like to see is obviously revenue growth. It's tough to fund a declining company. The predictability to get repaid makes it difficult. And a pathway to profitability. There are potentially venture debt funds out there that will fund hyper burn companies, but again, it's going to come at a cost to the entrepreneur. Obviously, understanding the use of funds, this will vary from institution to institution. For Lighter Capital, we like to see it going to growth needs or growth purposes, but don't necessarily have to. We don't require a proof of that. Where some institutions are really going to want to understand where that money is going to go and may restrict that a little bit more. Obviously, the management team is important, but it's not to the same level of the equity investors, because we're not trying to drive that 3x return year over year, but want to understand that it's a solid team in place. And what we want to see is really, the projections are obviously nobody's really ever met a projection they didn't write like as an entrepreneur, otherwise would not be doing this. The reality is it's really important to understand both the upside and the downside scenarios. So as you're planning it out and understanding, okay, I'm going to grow that 3x year over year. What happens if you only grow 1 times or even 50% growth? What does that look like in terms of your cost structure? And what is the impact on the company? And so are you going to have to cut heads, or are the gross margins high enough? And kind of just understanding that scenario is very important to the lender. In that same vein, the transparency and consistency is really important, because as you're providing all of this kind of the foundation for the underwrite that goes on, if there's anything that comes up in there that it's contradictory, right? The story you're telling doesn't line up with the numbers. that causes doubt, in the mind of the underwriter or the lending organization, and therefore that can lead to what we discussed before, kind of coming to that no because of the riskiness associated with getting repaid.
Alan, I got a quick question. I guess in terms of the deals that you guys do at Lighter, what is the thing? You have a lot of bullets here. Like, what do you love to see the most, or what are you most excited about when you're looking at potential companies to fund?
Yeah, I think it's really our foundation, Mike, is really kind of in the predictability of the revenue, high gross margin, so that if things, as I mentioned, that downside scenario, right? If you're looking at that, if things start to go the wrong way, that there's enough room there to keep the business going and potentially rebound from it. And then also, not being in a hyper burn situation. So we want to see companies that there is that pathway to profitability. But they don't have to be profitable. We just want to understand that they're thinking about how to get there, with the funds. I don't know if does that answer your question, or is that?
Yeah, cool, thanks.
Yeah, and so maybe this is a good segue. So kind of bringing those two worlds together, we're discussing debt and equity financing. So I mean, if you want to maybe just talk about maybe the high level takeaways, and if you kind of have some back and forth on that, but certainly maybe you can just cover what you guys see. And Mike, specifically as someone who's raised both debt and equity, certainly would be kind of curious to hear your takeaways on that.
Yeah, I guess I'll give it a start here. I think they both have a lot of pros, maybe just and cons. So maybe I'll just touch on both of those because I know I don't want to make it seem like raising VC is like a terrible thing to do. But with equity, I think some of the pros are the ability to fund a company that might be early on or might have a big vision, not necessarily the financial metrics where you can project a payback. So you have company or investors that are willing to fund you and fund that vision for the company. And I think what you get with equity investors as well is you get advice around the table, right? Whether that's through advisors or board members or investors directly, then they all bring a lot of value add to the table, whether that's hiring, advice, customer contacts, things like that. You do get diluted every round, 20 to 30%, because investors need to own a chunk of the company to build a portfolio and then ideally return that money back to their investors. And you might lose some control, whether that's through the board or ownership over time. So those are things I think that are really important to think about when it comes to equity financing. And then maybe I know we have a case study later on, and I'll touch on how we decided to go the debt route, but maybe hand it over to Alan here just around the things to consider and around debt.
Yeah, thanks, Mike. On the first, the debt side of things, obviously, dependent. A lot of this is dependent, again, in terms of what vehicle you're looking at in an institution. But one of the big things we see is the personal guarantees. A lot of these companies, our early stage tech companies, are still getting their footing and they're cranking. But that being said, that there's still the downside that exists. And to have to put everything on the line is a little bit risky after the risk that was already taken. So that's something to keep an eye out for in terms of these facilities. The financial covenants is another big one, right? As you mentioned, depending upon where you're at in the stage of the company, if you're trying to grow 3x, it gets really tough to have somebody telling you how much cash you need to have on hand, or what type of liquidity ratios you need to have, or go through the list of metrics that banks or lenders will typically impose. And so if while you're trying to really scale a business and put your foot on the gas, it can be difficult to do that if you're subject to covenants that can actually limit that growth. So if you are going down the route of looking at debt, it's important to understand how much those covenants can restrict your future growth. Another thing too is just venture debt, whether it's some of the tech banks or venture debt firms. Really, there's often, if not 100% of the time, there's warrant coverage, right? And if you believe in the success of your company and the future value of your company, it's really important to understand the true cost of those warrants. Because day one, there really isn't any cost to you. And so if you're looking at the all-in effective cost of capital, or the interest rate, it's going to seem very low compared to some other forms of funding. But when you look at that, when you actually account for the warrant coverage, things may not be that different when you think about it. So understanding how much that is being requested and the value of how they're valuing them is very important. Yeah, with that, I mean, I guess, Mike, from your perspective, I guess on the equity side, one thing that's really interesting is I agree with you, the value of equity investors in terms of the strategic advisory and that type of thing. How did you guys look at multiple, when you were looking for your investors, was that strategic nature important to you?
Definitely. I think, when you're looking at bringing in people to provide strategic value to the business, especially when you're raising equity financing, the people that you have around the table are very important, and you want to make sure everyone's on the same page. And I always use the sort of like getting in the same boat and making sure everyone's rowing in the same direction. Because if you just take the first check, they might have a different vision than the business than you, but you take it because it's the only one. That could prove to be very detrimental to the business, because you could spend all of your time disagreeing over strategy or something, versus like, hey, we need to grow and execute, and so everyone's got to be on the same page with what we're actually doing. So I guess picking the partners you work with is incredibly important, whether that's on the equity or debt side. But it's really important to value the relationships and the strategic value of the people that are actually backing the business.
Yeah, that's great. That's great. Yeah, I mean, I think that's, you mentioned before about the time it takes and the meetings it takes to find that equity, to find an equity investor, right? And it's the vetting should be done on both sides, right? As you're out there looking for the investors, it's not just one way looking for the check, right? Otherwise, it can be a very difficult relationship in the long term. That's a good point. As it relates, given that that you obviously have raised capital from Lighter Capital, I'd love to hear your side in terms of other options that you looked at, or what it was about Lighter Capital that was compelling enough to you to kind of get the relationship going. Yeah,
I think one of the things that we I don't want to steal the thunder, Tom's thunder for the case study, but one of the things that was really compelling to us were that these 3 bullet points here that you have for things of consideration, we didn't have with Lighter Capital, right? I don't think my family would be very happy if I gave a personal guarantee, or our investors would be happy if we had to give away warrants or have financial covenants. So the actual transaction and the terms around the transaction are very frictionless and lightweight. We strategically said, hey, we want to put some more capital in the business because we have some places where we want to grow and spend money on customer acquisition. We had product market fit down. We just wanted to spend some more money on customer acquisition. We want to provide a wage increase and get a lot of our employees a little bit more because they were taking a pay cut. And there's a couple other things we want to do with that. And we looked and we said, well, what are our options? And options are, one of them is kind of the equity financing. And at the time, we weren't growing 3x, right? Year over year, we were probably growing closer to 150 or 200%. And we could go and try to put together a round, but face dilution, face a lot of problems or just distractions in terms of that's going to take away from the day-to-day of the business. So what are our other options? Well, we came across Lighter Capital maybe a couple of years ago or a year ago and some change, and learned about the model, and I thought it was really interesting in terms of we have insane gross margins with our product in terms of what it costs us to actually serve that customer, and we loved that compared to other types of lenders, these 3 things weren't even an issue for us. So it could be really not burdensome on the business at all. Let us put some capital to work and then get us on that path to maybe growing 3x year over year, or even maybe refinancing and putting more capital to work down the line. So those are a lot of the things that we thought about at a strategic level when we were talking with our board.
Absolutely.
Excellent.
That's great.
Well, great. Well, that's a good segue. So as you may have guessed, we do want to discuss the actual case study of what happened with Visible.VC and their successful capital raise to secure growth financing from Lighter. So if you look at the timeline here, really from that first phone call, there was a prior, I guess, conversations, but really when we re-engaged with the intention of exploring capital raising, that first phone call was October 12th. Mike was very prompt, as we'll kind of see in the next slide, kind of very proactive. The next day, submitting the application, getting all the documents that he required, or that we required rather, he put those together just the very next day. That allowed us to move that very quickly to due diligence just a few days later. And then you can see it went to the credit committee on just 5 days after funding, or after the application, and terms were offered on the 18th, and then money was wired on October 27th, as just 15 days after that initial kind of discovery phone call, which is remarkably fast. So I should acknowledge, so that's a question of, that's what happened, and now we're going to talk about how it happened. And so I think it's important to recognize that really the speed of this deal could not have happened without Lighter Capital's underlying technology that allows us to process financial and legal data at a very high velocity. However, this is the fastest deal that we have ever funded, so there was something unique about this. And I think that the underlying principle here is that it was significantly aided by the level of preparedness and responsiveness from Visible. And so, for example, when asked to produce various detailed reports, including variations of churn data, Mike was responsive and in many cases very proactive in getting the underwriting team the information they needed. So this promptness and preparedness created very much a sense of confidence, transparency, and demonstrated that the CEO clearly understood their business. So Mike, I'd love to hear your experience, if you have anything to add from what it was like to work with Lighter Capital, but certainly you provided a huge amount of information up front and kind of greased the wheels for our fundraising process.
Yeah, I think one of the kind of key takeaways going through that process, and even talking to our current customers at Visible, was around, I think the lender is willing to move as fast as you are. So once we made that decision to talk to potential lenders, we were ready to go, right? Because we had these bullets that you laid out here, but it really shouldn't be the lender holding things back. It should be the company. And if you're ready to run, I think they're ready to run with you. And the technology that you guys had was great, right? I just had to upload financials, and those were scraped automatically, and bank accounts and things like that. And then we, at Visible, what we do is help companies transform their data in a way that can be reported. So just by nature of kind of dogfooding our own product, we had a lot of these churn reports ready to go. We had really clean customer data that we can slice and dice anyway when it came to being able to fill those requirements out. So I think it was a combination of how easy you guys make it. We were ready to go strategically, and then just by using kind of our own product, we had all that information at the fingertips, so that allowed for a very kind of seamless end-to-end transaction.
Yeah, perfect. So clearly, I think there's kind of a perfect storm here of, we are a tech-enabled lender, so we are able to process data quickly. You, with your product, are able to provide us that data very quickly. But I guess if there's kind of one takeaway from today's lesson, it's understanding your own business. And so I'd love to give you the opportunity to explain what that means to you and kind of how you're able to communicate that with other people.
Yeah. So I think I love data and KPIs and using those to inform decisions, and being transparent with your business. And in our case, with our team members, our investors, our lenders, has way more advantages than disadvantages. I think people are scared to be transparent because it might not always be the best news. But if people know what's going on and there's no uncertainty in their mind that those people that are working for you, they're gonna go to bat for you. And so I think it's really important to be transparent. It's really, really crucial to have reliable kind of data sources and clean data. I think when we probably started the business, it was dirty. We were mixing data that was our customer data with our own data, and it was kind of skewing things. And just being able to have some clean data that you can report on and spending the time to do that, I think is crucial. It sucks because you have to spend time and resources up front, but it only continues to pay compounding dividends over time. And then, you can obviously use this to make those decisions, right? So when we were sitting down and saying, great, how do we want to finance the business? We could clearly take a look at our metrics and say, yep, this makes a lot of sense in terms of what we need at this given point in time in terms of the financing. So kind of touching on what data and KPIs should I track? This goes in, I think, applies to both lending and venture capital. And the first is, you should find a great partner on the finance and accounting side to build really clean and easily accessible financials. So, being able to pull down your P&L or your balance sheet or cash flow at any given time and know what it's saying, it is really important. And there's a ton of great providers out there that will work with you and do that. We love to work with ones like QuickBooks or Xero, so you can take that data with you. You're not locked into any particular system. And then the true north KPIs, these are really important. If you think of, everyone here probably loves talking about SaaS and revenue metrics, but that's probably actually a lagging indicator, right? When I'm reporting MRR at the end of the month, that's what happened the month prior. So you want something that's more of a true north KPI. What is going to infer MRR? And for that, at Visible, it's product qualified trials. That's what we rally behind every single day with our internal team, with our investors, with our potential investors and lenders is, great, how many people do we have coming into the software taking some key actions? And so for us, product qualified trials is crucial because that's an indicator of how healthy our pipeline is and what we can expect to close. And then the last one, I think this is really important for both lenders and VCs is kind of that quote unquote CRM data. So being able to have just a very clean list of, great, how much are your customers paying? How frequently are they paying? Are they paying monthly? Are they paying quarterly, annually? What's their contact info? So, being able to pull down things just from sales tax for certain states to being able to break out customers by geos, having up-to-date contact info is great. And then where did we acquire that customer? Did we acquire them through maybe paid search? Was it a referral? Was it a field event? So having all of that structured data at the customer level makes it super easy to pivot on it, report on it, filter it down. And that was crucial in being able to provide all that quickly back to Lighter Capital. And then informing management decisions, so internal decisions. What are our best channels and how are some performing better than others? So for us at Visible, we were looking at paid channels and, great, where can we spend some more money and really pull that lever? Because, hey, we're converting at 15% with this one social channel, and maybe we're only converting at 3 or 4 at this other one. So let's double down on the one that's converting the best for us. The other thing we did was kind of doing churn by customer segments. We actually realized recently that customers that are paying us less are churning much more frequently. So we're doing some work around being able to price our product at a higher point, even eliminating lower price plans, because just we were having higher churn with people that were paying us less, and they're actually more demanding in terms of the type of functionality and features that they needed. And then a big one, right, is are we growing fast enough to hit those fundraising milestones? Whether that's, hey, maybe we want to get another line of credit or a revenue line from Lighter Capital, or we want to go and raise more VC for a new product line. Are we growing at the rate we need to be to hit those milestones? And if not, what should we do? And then kind of related to all of that is just like, all right, what's going great? We look every week, what's going great in the business? What do we double down on? And maybe where should we hit pause? Like, hey, this campaign is not working, or this feature set, no one's using it, let's get rid of it. So we always are taking a look at, where should we double down and where should we hit pause and sunset something.
Yeah, that's great, Mike. The one thing I love about this is just the fact that the data informs the decision is, in our portfolio, we've seen a clear connection between the identified use of funds, right? And when people know where they're going to put it, and the subsequent success and the growth of those businesses. So it's understanding exactly where to put the dollars to work to drive the growth, as opposed to, I just think I need some capital, I need an injection, but I don't know where it goes. This is, it really aligns with where we've seen the success in our portfolio.
Yeah, and so now as we're kind of entering the home stretch, we got a few minutes until we're hoping to get to the finish there. So we'll kind of maybe go rapid fire. We'd love to hear, your take on how to engage in communications with stakeholders and kind of what that means and how you've been able to be successful in that.
Cool. Yeah. So we'll just break it down quickly by how to reach them, how frequently, how proactive. So let's just start with kind of how, when, and where. So I think it's really important when you're engaging with your stakeholders that you reach them where they usually are and not add any friction to that. So, email is kind of the most ubiquitous communication tool. So being able to produce a stakeholder report and send it in email is going to be the best bet. Don't make them log into something. Don't make them download something. Put it where they already live. And again, that's usually email. And then people, are always asking us, well, great, how frequently should I be communicating with a lender or potential lender or investor? And this is not a hard and fast rule, but typically, I'd say concise monthly reports are always better. They're going to get read more and you'll have more engagement around them. And I break that in between the $0 and $5 million in revenue. If you're more of a growth type business that's doing more than $5 million a year, I think you're okay getting away with quarterly reports. But again, that's going to take you a longer time to put together and it's going to be more long form. I'm always more of a fan of concise, actionable things that you can send out. And then just being proactive. So we did a big study around follow-on financing and people sending out updates to their investors. We found a direct correlation that companies that are sending updates out to their investors on a regular basis are 200% more likely to get follow-on funding from that investor. Because if you think about a portfolio of an investor, they're more likely to double down on the companies where they know what's going on versus someone they haven't heard from in 9 months. So being proactive is crucial when it comes to stakeholder reporting.
Cool. All right, 1 second. Next slide. There you go.
Yeah, great. So, who should I be reporting to? I love doing a Friday CEO note. So internal team and management team getting a note every Friday from me. I love sending these out to investors, advisors, lenders every month. And then, I think really, really valuable is to treat potential lenders, investors, and even hires as a marketing campaign where you're dripping them information maybe every quarter about what's going on. And that's going to help someone connect the dots. And that shortens all types of cycles, whether that's a hiring cycle, fundraising cycle, lending cycle. Being able to drip that information to them over time is going to really shorten that down.
All right. And
then real quick. So keep it concise, like I said. Make sure you always are using comparable metrics and rates. Don't compare metric A to metric B the next period. Always report cash in hand, your burn, your head count. Include those true north KPIs. And then really just ignore all that and just do it. Because what's going to happen is you're going to get feedback, you're going to iterate, and you're going to keep improving. So once you get that first one out, you'll quickly understand what your stakeholders love to see, what they already love seeing, and you'll get a lot of feedback from sending it out. I think everyone would be delighted just to have that first experience and hear from you.
All right, thank you so much. Now we're going to have a couple of recommendations, one from Alan and then later for Mike. So Alan, give us some recommendations for anyone, advice you would give to them who are seeking capital for their business.
Yeah, I don't think this will come as any surprise to anyone based on the kind of content of today, but ultimately it's just transparency and being forthright when building those relationships with investors. I think to Mike's point that you're 200% more likely to invest if you keep that information flowing. It's good, it aligns very well. Just understanding that strong knowledge of your business, your financials, your metrics, everything else, being able to provide it as well as speak to it and having a deep understanding of it builds that trust in business and the entrepreneur. And like I said before, understand both the upside and the downside. For equity investors, you're more likely focused just on the upside, whereas for debt investors, they're going to want to understand that you've kind of thought through that and can understand where to cut cost if necessary, if things change a little bit. So,
excellent, thanks, Alan. And Mike, any last parting words here?
Yep. When it comes to equity financing and fundraising, it's a process. I think I mentioned that earlier. Treat it as such and make it a full-time job. So if you're going to do it, and treat it as a process, have a start and an end date, and go full board on it. Having structured, clean, reliable data makes everything easier, from those strategic decisions I mentioned to fundraising milestones. And then relationships are incredibly important. So get intros from friends, family, other co-founders, people in your network, and keep them up to date on a regular cadence. Again, lines, not dots. So building relationships is super important, because when you are ready to make certain strategic decisions, you'll have a pool of people that you can pick from. They can compete against each other on a deal, and so you'll get better terms regardless of what you're doing. So making sure that you establish those relationships early is instrumental.
Fantastic. All right, guys. Well, we're going to enter the Q&A here. Just before we do that, we actually just want to provide contact information. Obviously, a huge thanks to Mike and Alan for joining. And you can see our contact information. If you're interested in learning more about Visible, certainly reach out to Mike at his contact information provided here. And Alan and myself, I'm the Director of Partnerships here at Lighter Capital. And just as the Q&A, the first couple questions that I've seen here regarding the recordings will be available. So we will be providing an email to everyone who registered and those who are attended. So you can expect a recording of the webinar as well as a copy of the slides. So just looking at we got a few questions in here. This is for Alan. What is the typical time frame for Lighter Capital funding? Maybe that's just to kind of get clarification about how quick the Visible funding was.
Yeah, absolutely. And on average, we're probably anywhere from 4 to 6 weeks. So the fact that we got it done in 2 weeks with Mike is a testament to the data they had available.
Thank you. And Mike, we got a question here for you. So it says, how much comms is too much? And so maybe that's with regards to updates to stakeholders. So is there kind of a line you draw where you don't want to go past it?
Yeah, I think that probably depends. I would say if you're doing it more than once a week, it's probably too much, especially maybe as you're more of a mature business. I think early on, especially as companies are going through accelerators or kind of finding their voice and their product market fit and things like that, I get a lot of weekly updates from people I've talked to. So I don't think there's ever too much, and hopefully that stakeholder will probably let you know. But I mean, if you're doing it more than once a week, that probably is a lot. But really, people love to hear from you, especially your stakeholders, because they're only successful if you are successful, right? Their success is pegged on you. So they really love to hear what's going on. They really can't get enough of it.
Excellent. Just looking here at a couple other questions. And so I guess this is maybe for Alan. So what's the earliest stage of company which we would seek to invest in?
Yeah, so the $15,000 a month in reoccurring revenue is kind of the starting point, or $180,000, $200,000 a year. At that point, we can, at 15 a month, we're lending probably 50 grand. So it's a way for people to, but we can do subsequent rounds. So we've had many cases where we started out with 50,000, we funded upwards of $1.5 million over the course of 18 months. So.
Mm-hmm. And I guess the next question here is how much of the presentation, or how much of this discussion is unique to SaaS businesses versus, say, a hardware or product business?
I think when it comes, I'll let Alan speak for lending. I think when it comes to, at least on the VC funding side, I think this is probably applicable to a lot of it in terms of communication, building a pipeline, of how you're reporting. My guess is that SaaS is a great vehicle because of the gross margins and predictability and things like that. But I'll let Alan kind of take it home on the difference there.
Yeah, it's interesting. So when you think about product business, where we, at least from Lighter Capital's perspective, we obviously, as I mentioned earlier, like to see a higher gross margin business. So north of 50% is how we define that. When you have a product business or a hardware business, it tends to be that those gross margins tend to be compressed because of the cost of the hardware. So typically in those cases, you're probably going to want to look at more of an AR line potentially, or some type of inventory financing, rather than a traditional our revenue-based financing.
And so looking at next question here is consider a startup that has 30K in MRR, but 20K comes from one customer, 5 from another, and the rest are distributed. Is that good, bad, or neutral?
Yeah, I would say we don't necessarily, from Lighter Capital's perspective, don't look at things as good or bad. We just look at it at maybe not the right time. So in that case, as it relates to getting financing at that point, it would be a little bit early. Logic being that the concentration risk of that $20,000 coming from one client puts the predictability of repayment into question. That being said, if there's, we've seen a lot of cases where, we have fewer customers, but those contracts they're not cancelable, or if they are canceled, then there's a termination fee. And so understanding the nuances of the contracts would be the next step.
And here's another question for Alan. So do you require institutional investors to be in the company prior to investing, or you invest in a bootstrap company?
That's a great question. Yeah, we're agnostic to the cap table. So if somebody, as in the case of Visible, they had completed their seed round. and wanted to bring in Lighter Capital kind of for that in that middle, kind of probably leading to, I'll let Mike speak to this, but leading to the A. We've funded companies that are bootstrapped. We've funded companies that are in between A and B. So bottom line is that we're agnostic to the cap table.
All right, well, that looks to be the questions available. So I want to say a huge thanks to everyone who was in attendance, as well as our two presenters, Mike and Alan. You guys did a wonderful job in providing a lot of insights that hopefully will provide you, the audience, with some good tips and tricks as you're seeking to raise your next round for your business. So I want to say a huge thanks. And again, you can expect a follow-up email with a copy of this recording as well as the slides. And we hope to talk to you soon. Thank you.
Thank you, everyone.
Thanks.